With higher time frame analysis, typically from a swing trading perspective, I start off on the weekly bar chart. So here is the weekly chart for Caterpillar. Now, I've got my dual Stokes at the bottom. Okay, I call this the 34D, and then this guy is the signal Stoke. I think that's green. In this particular case, you'll note again, so get in the habit of using your drawing tools. You'll notice that right here is a swing high. The market then pulls back down to a swing low. I'm going to draw a horizontal rectangle, and you'll see that price remains inside of this area, which is a high of 180 in CAT, a low of 115. So we've got a $65 window. And actually, if we come over here and we take out those 4 days, the window tightens to 164 to 115. So you see that literally 100% of the price action is contained by this sideways channel. So what I tend to look at is directional market movement that looks like this. All right, let's see what the brush looks like. So in a bull continuation pattern, a bull market might go up, and then it goes sideways in a consolidation period. And during the consolidation phase, you have resistance. Resistance is holding the market from going higher. Sellers are coming in at this point. Buyers are taking profits at this point. The selling overwhelms the buying, pushing the market back down. Because this market is making a new high right here, we would tend to have what we call a bullish bias. So if we are biased and we're trend traders, our bias is bull. We want to be buyers. So we tend to want to buy levels of support, sell at resistance. Buy at support, sell at resistance. Buy at support, the expectation is that the trend will continue at some point. So if it does, market will retest this area, then it will break out of that area, and then the classic verbiage is previous structure resistance, once it's broken, is anticipated support as price pulls back down to it. Now all of the sellers that were selling here, here, and here are looking to be buyers. This can become a new price of interest for future traders. So we would expect it to come back down here. The buyers start to jump in this region. And now we anticipate that if the buyers take this market higher, it's a reasonable expectation that price will come up and hit this level next, another level of resistance. So we'd come back up to here. So as you see this market right here, this is a bull continuation pattern. It's a market that right here has an impulse move. And you can see this movement right here is pretty uncommon. Literally almost every single consecutive candle, you see this bar is a higher high with a higher close. Higher high with a higher close. Higher high, equal close. Higher high, higher close. Gap up, higher close. Higher high, equal close. Higher high, higher close, and so on. This is very uncommon to see this. Tom DeMark did research back in the day, and he had the rule of 9 and the rule of 13. It's very uncommon for any instrument, stocks, futures, whatever it might be, to have 9 consecutive higher highs and higher closes without a pullback. And then the next number I believe was 13. So right here we go on about a 20-day run. See this right here, guys? This is just really uncommon. Let's see. Where? Oh, there it is. There's my magnifying glass. So, again, look at this. Higher high, higher close. Equal high, higher close. Higher high, higher close. Higher high, higher close. Higher high, equal close. But the close of this candle is still above the high of that candle in the close. Higher high, higher close. Then a little bit of consolidation and then a continuation. So again, this is very uncommon. And you'll learn that kind of, as you get more acclimated to price action. So this is also common. After we've had this massive run, the buying is exhausted. The sellers come in, and the sellers are people that were long from back here, they're taking profit. People that recognize this market was at an extreme overbought position. See our double stoke? It's at 98, and all three of them are peaked at 98. That is very uncommon. Very uncommon. Okay, so then as we pull back down, now we have a period where there's no news, nothing to drive any further interest in this particular product, Caterpillar. And with stocks, we have quarterly returns. So during this period, we go through April, July, October, and then we go through 4 quarters right here. So even the news announcements aren't enough to take this and break this out. Here, we have a failed attempt to move lower, and then 1, 2, 3 bars later, we're right back inside of this sideways channel. And then what happens? Finally, we get some type of news event, we break out of the resistance highs, and they take off again. And again, we go right over here. 1, 2, 3, 4, 5, 6, 7, 8 out of those 10 days, we had higher highs, higher closes. Okay, so what I did right here was I took the most recent impulse leg from that low to this high, and I drew in what we call a Fibonacci retracement. And then I'm going to identify a sideways channel. Okay, so on the weekly, I've got a significant resistance. I've got a buyer support. Now, how am I identifying the support and resistance? This is where your oscillator comes into play. So note right here, our 34D, our bigger oscillator, buries itself, comes all the way down to 11, and then the blue line crosses above. I guess, is that gray or is that red? Black, yeah. Okay, so we'll just darken that dude up a little bit. Okay, so blue crosses above black. That is a signal that the market is extremely oversold. So I'm going to set this area right here as price rallies. I'm going to set that area as what I call support. Price pops up right here, and we find an area of resistance. Now you'll note I've already drawn in my horizontal lines. So now as we advance the chart, the cool part about what they've updated in TradingView, I'm on a weekly bar. So every time I click the button, it shows me 1 day's move inside of that 1 week. Does that make sense? So there are 5 days in every week. So watch this candle. That day closed higher. The next day we closed lower, but we stayed inside of the high to low range for that week. Now, the next day, price made a lower low and we got a lower close. So now we're trading at the lows of the week. And then there's the open of the next week. So this would be Monday. We make a lower low, lower close Tuesday. Wednesday, we go lower low, lower close. Thursday, our weekly low holds. We pop back up, a little bit of buying. And then there's the next week. Okay, so there's our support zone. So when I identify these key levels, you'll note, here's our extreme overbought again, and back down to our extreme oversold. Now let's take the chart from a weekly down to a daily. Now what we'll start to do is we'll start to look for trading signals at the support and resistance levels. Okay, so the underlying trend is bullish. Boom, bullish. And then we pull back down to this key Fibonacci level, the 382. Then we look at the daily bars, and right there, again, see this? That's a visual that you want to burn into your heads. The signal stochastic, this guy right here, buries itself. Oh, look, all the way down to 5. So if we really wanted to get extreme, we could come into our double stochastic, and instead of 84, we could rally this up to 89. We could move this down to 11. Now we're really only able to recognize the really extreme overbought and oversold conditions. So part of the requirement would be all 3 of these have to be above red. All 3 of these have to be below blue. And I prefer if they flatline. Okay, so for me, flatline is when they press and then they go flat. So they'll go completely sideways down here. And again, what, huh? Yeah, yeah. So one or two candles is fine. Remember, what this oscillator is doing. It's comparing the close of this bar to the recent X number of days high and low average. So what drives this down is this quick movement. So look, this candle, and again, let me just draw some basic technical analysis. Here's a low. We trade below the low and then close above it. Here's a low. There's a retest of the low right there. And then right here, we get a momentum breakout. So this candle is a big outside candle. And when we say outside, what I'm looking at is I'm looking at the range from the high of this candle to the low of the candle relative to all of these others. So can you look at that candle and see that it's about 2 times the size of the last 5 candles? Okay, so that is big. So for some reason, the market gapped down. We went from that bar close at 203.65. In the overnight trading, we gapped down and we opened the next day at 201. So that's a 1% gap down. On top of that, during the day session, this thing went straight down. See this big red candle? And it closed all the way at the lows of this candle. And these lows took out the prior 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16 days of data. That's that's 3 weeks of trading, because there are 5 days, 5 daily bars per week. So something caused the gap lower. Something caused the outsized range of this candle. It caused this market to break below and close below 3 solid weeks of trading. And then from there, we gap down again and close lower. We close lower. We close lower. And then here we gapped all the way down to here. So let's look at this bar. Okay, that's the close of this candle. Okay, that's February 23rd of this year, the close. Now, the next candle, that was at 186.53. The next day, right here, 224, we opened at this guy right here. So the open is the horizontal bottom at 181. So again, this is a massive gap down. And that's what caused this thing to go from 48 straight south to 11 in only 4 bars. So remember, these indicators are derived from price. So these are showing us price action, but in a different visual. And anytime this guy goes to an extreme oversold condition like this and flatlines, there's been quick bearish or downward movement in that particular stock or instrument to produce this visual. Okay, so let me stop right there and let me see if you have any questions. Perfect. Okay. So the basic. Oh, okay. Go ahead, Oliver. Yeah. Oh, fine. Completely disrespect me. I put this channel together. That's right. We will. Yeah. So do this, guys. This will help a lot. There you go. So when you look at this, um, disregard the time frame. Okay. So and again, I'll just go back to when I used to teach in the prop rooms. A bar of data is a bar of data. Okay. So this indicator is agnostic. It doesn't care what this instrument is. It doesn't care what time frame this is. Okay. So as far as this, any indicator knows, and any technical study. So I want you to view these indicators kind of as robots. They have no emotion. It literally is a mathematical formula behind here. And it says if this instrument advances, advances quickly, and the high to low range of each of these bars is significantly higher than it has been over the most recent X number of bars. Let's go back in here. So this length 1 is 21. That's this guy right here. That's the slowest that we've got. But then the other are very fast. So the K1 is 3. So this literally looks at this bar's high, or I'm sorry, this bar's close relative to the prior 1, 2, 3 bars, high to low range. And that's what causes. So look, see this big red candle that closed below the prior? Look at the impact it had. This green indicator right here was plotting at 94, and in one bar it pulls it all the way down to 67. That's 27-point moves, or 27% in one candle. So this has given me a visual reflection of what happened up here. So Oliver, so the indicator doesn't know if this is 1 minute in Tesla, 1 day in Caterpillar, or 1 week in Apple. It doesn't care. Just a bar of data. Okay? Okay. So, yeah, so when we see this, we still take the same action regardless. Now, what will change is obviously if I'm trading Caterpillar at $181 and I'm just trading the stock and I don't have any margin or leverage in my account, I need $181 minimum for every share of stock I want to buy. And then the risk is going to be bigger because each one of these daily bars, you'll see the high of this candle is 189. The low of that candle is 180, let's call it 84. So this thing moved $5 in 1 day. If we were on a 1 minute, we could risk maybe 50 cents or $1 and not have to worry about it. You with me? Yeah, I think Ollie got booted. Yeah. He's playing Xbox in one and trying to listen in the other one. Okay, so all we're doing here is we're establishing areas of support and resistance. Resistance is equal to an area where the sellers have come in before and where price has been rejected and in this case rolled over. Support is an area where the buyers have come in and we anticipate that price will move higher off of that level. So when we find our key levels of support and resistance, we can then remain patient and identify key levels. Okay? Got it. There we go. All right, so let's tighten this down. Now, we talked a little bit about risk and reward. So this is what I want to show you. If I'm a buyer at this level down here, my risk is right here. So let's say we're going to risk $10 per share on Caterpillar. My stop's going to go below this price swing right here. Now, if I go for a $10 profit, I can reach my $10 profit, which is 1 times my initial risk here. A $20 profit, by the time I get to my black line, that gives me 2 times my initial risk in profit. Then if we go up and touch the top of the resistance level, which would be expected and would be a reasonable expectation, that would be 4 times my initial risk. So we can also use our support and resistance levels for entry signals as well as profit targets. All right, now let me take this out. Well, here's what we'll do. I have an expectation that the price is going to move from here back up to here. If we get back up to here, we're going to look for a sell signal. If we get a sell up here, I'm going to expect price to move back down to here. If we get back down to here, I'm going to look for a buy signal. I'll expect price to move back up to here. And when markets move sideways like this, we literally can go 75% accuracy until it breaks out. Obviously, it's not going to continue in that pattern. At one point, it's either going to break our support and we're going to go to new lows. And in that case, we'll get stopped out. Or we'll break the resistance up here and go to new highs. And we can manage that with multiple positions. All right, so let's roll. So right here we get long, And right there we hit our 2R target. So from our long entry down here on our oscillator, all we did was looked at the oscillator at a key level. And right there we produced a $20 winner per share, and we'd still be long the stock right here. Perfect. Perfect. So let's use this horizontal line tool, and I'm going to draw this in right here. And now we're going to talk about the basics. So we're going to talk about multiple positions. And this is the way to take care. So I call this pay the fear. Fear is false evidence that appears real. And we also want to pay the greed. Okay? So, again, we're all driven by emotions. We want to move away from pain. The trader that wants to move away from pain never enters this trade because the thought of losing on the trade causes pain. I want to avoid that pain, so I just never enter. I never trade. Okay? The pay the greed, the trader that got long right here, it pops up to here. I've made $10 per share on my trade. I'm doing backflips. I'm looking in the catalogs, and I'm on eBay getting ready to buy my $10,000 watch. And so I pay the greed. I want to take my money now. I want to take it. So typically greed is driven by money and then also time. Okay? I want to get in and out quickly. In and out quickly. That's appealing to people. We want instant gratification. Now let's go to what Wells said. The way that we can do this, we're going to pay the fear and pay the greed. So we enter the position right here because we want to follow the rules. We're going to cover part of our position, I call the scalper, right here. And that typically is at 1 to 2R. Okay? So that's 1 to 2 times the risk. So if I risk $10 on the trade, I want to make at least 10 and possibly 20. The second half of the position, let's say we bought 100 shares, I call that the trader. And go ahead. Yes. There you go. Cover, sell, take profits. Yeah, profit taking. Yep. Okay, so on the trader, then the trader I can look for 3 to 10R. And that's how we come in and we start to trail stops just like you said. Okay? So if I cover the scalper right here at 1, 1.5, or 2R, now I've paid the greed. The greedy trader says, great, I got part of my position out, and now I take my protective stop and I move it from risking $10. I pull the stop up to what we call break even, and that basically would be my point of entry. Now, what is my risk in the trade? If I pull it up to where I entered, I have zero risk now. Okay? Okay, now let's look at this though. The market is trading all the way up here. So my risk is zero in literal loss, but I'm risking $40 in open position profit. My expectation is price is going to move back up here and at least stall at this level. We're getting close to that, and look what's going on with our dual stoke. This guy is extreme overbought all the way up at 97. So this is where I start to anticipate a pullback. I've got a massively overbought oscillator, my double stoke, at a resistance level right here. So now what I want to do is I want to aggressively trail my stops. Okay, so let's come in here. Let's take our stop from here. And now let's trail it. So I can take it and trail it right below the blue line. That gives us an objective way to trail the stop. Make sense? Okay, so let's just say again, let's give us a long entry. After this bar hit our level and then gave us a higher close, we'll buy the next bar. So let's call it long from 185. Right now, the stock closed at 224. Our stop is down here at our blue line at 207. So we have a locked in profit, not realized yet because our stop is there, but we're going to lock in $26 a share on the second half of the position. So if I'm a back tester, okay, I'm going to come in here and I'm going to record this. I'm going to say my scalper, SC, made, and let's say that we wanted 1.5R. So it made 15 bucks a share. My trader, TR, I'm locked in at, what did we say it was? 185 to 207, $22 a share. Okay. Now, as I continue to backtest, I can either A, set a profit target right here at that resistance level, or B, I can continue to trail below the blue line. So what we'll do now is we'll continue to advance, and we'll use the blue line as an exit. I got you now, bud. Okay. 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 All right. So we waited for price to come down to our level. We looked for all three of our oscillators to bury and go flatline. And we waited for a higher close, and then we bought the next bar market. We took half off. We risked $10 in the trade. We took half off at 1.5R. We made our 15-point target right here. And now we were trailing our stop behind our blue line for the second half. Because Wells asked about if we cover everything here, then we're flat and we don't make anything when this market continues to run. And just so you know, it's not a question of if it will continue to rally, it's when it continues to rally, will I participate? And again, this is a critical time for a lesson in your favorite, psychologies. So the psychology of the trader is, I want to get out, I want to get out, I want to get out. I want to take my money right here. And this is very, very common amongst all systems that I've ever been a part of, ever seen. If I take a quicker target, a smaller target, I have a higher winning percentage. And that's why I showed you the other day, yesterday I guess, about the expectancy formula, right? Remember we talked about having a 75% win rate, but if my losers are bigger than my winners, I still lose money? Okay, so some of the best traders in the world have win rates that are 35 to 45%, but their average winners are 4, 5, 6 times bigger than their average losers. So if they risk $10 on this stock, they're looking to make $40 to $60 on this stock, and they do it regularly. Okay? All right, so the second half of this position, we got long at 185, and we had our stop right at that blue line, so we got stopped out right here at 218. So that one actually made $33. Okay, so there's 33 bucks. All right, now, if we did 50 shares up here, what's 50 times 15? Wells, Oliver, quickly. Okay, 750 bucks. There you go. All right. So we made 750 on our scalper. Nice, good answer. Gold star. We made 750 on our scalper portion of our position, and then we remained long. So we took 50 shares with us up to our trail stop, and that one made 1,650. Okay. All right. Now let's take a look at this. Our initial risk on 100 contracts or 100 shares, remember we risked 10 bucks a share times 100 equals $1,000 of initial risk. Okay? So we made a 75% return. We made 750 on the first half, and then we made 1650 on the second half, which is 2400. So we had a 2400 profit on $1,000 of risk. Okay, so our overall was 2.4 R. Okay, our risk was 1,000. Our reward was 2,400. So our reward was 2.5 times the size of our initial risk. Okay? Any questions? Okay, so I always encourage to trade multiple positions for this reason. Here's what happens if you don't. Okay, first off, from the point of entry, we were in the trade 1, 2, 3, 4, 5, 6. On day 7, we hit target 1. So if we covered our entire position at target 1, we would have made $15 on 100 shares, or $1,500. That would have been a 1.5R on $1,000 of risk, and we're done. Now we have to, our capital is where? Our capital's on the sidelines. Our capital's no longer in the market. Okay, so we don't have any market risk, but also the next day, look, we got out on this day and we're like, hell yeah, 150% return. We're posting in on every frickin' IG and TikToking it and whatever. And then the next day, this market gaps higher. And 3 days later, we're going, what the? I should have trailed my stop. I could have made 2.5R. And then 3 days later, I could have made 4R. And so we go through the coulda, woulda, shoulda. So that's why I always encourage, go ahead and pay the fear, pay the greed right here. The fear of letting a winner turn into a loser. The greed, let's go ahead and take it quickly. I've got 150% return on investment in 5 days. Let's take it. Beautiful. But let's leave half on, because, and by the way, there will be times when the market will go up here, it'll hit our target, and then go straight back down and we'll get stopped out on the balance. That'll absolutely happen. But there will be plenty of times when the market goes up, hits our target, goes up, goes up, goes up, goes up, goes up, hits our second target, or we get taken out on a trail stop. Okay? Questions? Okay. Okay, so we'll remove the drawings. All right, now, so what I'll be doing here is, now let's just go ahead and we'll walk forward. Okay, now, see how our oscillator went extreme overbought right here? I'm going to take this. I love to use the horizontal ray. Anytime I see a level like this where my oscillator was extreme overbought or extreme oversold, I wait for the market to peak and start to roll over, and now I'm going to drop that line in right there, and I'm going to consider that resistance. And I would encourage you to use the same type of line. So resistance for me will either be red or black. Support for me will either be blue or green. Okay, so we'll take this guy, we'll make it blue, and you can make, so you get a little deal down so you quickly and easily know. For me, if I have a weekly key support level, as an example, it would be a red, solid, double thickness line. A minor support level might be a minor resistance level. Let's go here. Let's call this a minor resistance level right there. So I will make this red, and then I'll come in here and it'll be dots. So I'll say that this swing has less significance than this swing, and then the distance between, see this little double top right there, and then again price moved lower? The distance between this guy at 226 basically and this guy at 230, that's a $4 offer zone. So the sellers still wanted to be short up in this area. The buyers that got long down here still ran out of buying pressure as it rallied into this area. We didn't quite get back up to here. Okay, so this now has become a little zone. All right, let's continue to walk forward. Okay, now we retested the zone, and now here we closed above the zone, closed above the zone. Now we might be back into a momentum market, so let's see what happens. Look at that, an immediate reversal. Yeah, exactly. Okay, so guess what I'm looking for? I'm looking for a pullback to my blue line again. What about right here? What are we going to do right here? Nothing. Yeah, but I got a trade. No, we do nothing. Patience. grasshopper. Okay, we're back into the resistance. Is my oscillator overbought extreme? Okay. Okay, now, yeah, that's a good call. So see where it's overbought right here, extreme? The green line is always going to lead the other two because this one is more erratic. It's on a shorter time period. So this guy already went overbought, and it remained overbought until these got here. So here's what I want you to do. Come over here, and as you're replaying, drop that in. And I want you to find the swing point. Notice how this swing high popped right up to that key level, and it stopped on a dime. And this is where you can come in and see this. See how we got this? We went up to that level, price got rejected, came back down, and it closed right on our resistance level. Now, we had that resistance level drawn in from January 18th of 2022. We tested it right here on April 18th. We made it above there for only 3 days, and then it failed. And now we're back at that exact same level, and again the market stopped there on June 8th. Key resistance levels. This happens over and over and over on any time frame in any market. So when you start to see the repetition, when this goes oversold and we're near support, when this guy goes overbought and we're near resistance, when this guy goes oversold and we're near support. So right here, we're not really near any of our support levels, so I don't pay nearly as much attention to this guy. However, right here, we want to be a seller. So come over here in real time, because I don't have an outcome bias. I don't know what happens next. Come over in real time. We're going to go short. I'm going to sell the open of the next bar. So I need one bar. I got short right here. My protective stop has to go above the swing. And I'm going to look for a 1.5 profit target. See that 1.5 right there? Okay, very simple. If price goes up here, I'm stopped out and I record that as a loss. If price goes here, target 1 is hit. I record it as half of my position off for a winner. And then I'm going to trail my stop above the blue line or until we get back down to here. Did we hit target 1? Okay, so from the entry 1, 2, 3, 4 on day 5. Now guys, this, because of how rapidly this market moved, this would have been an amazing options trade. We would have made 2 or 3 times more money if we would have bought a 215 put on Caterpillar. But at the time, obviously, we have no idea that this was going to happen that quickly. My guess is this is likely a news event. How do we know that? See how we gapped lower here? Yeah, well, okay, so this is the 9th. That's the 10th, so that's the very next day. So my guess is we had a news event this day, might have been earnings. This is right in the middle of June, earnings season. Gap down, and we sold off the whole day and closed on the lows. Gap down, sold off the whole day, closed below the midpoint. 2 days of consolidation, and then another big smackdown. They went from 206 and opened all the way down at 201. A 2% move overnight. And right there's our first target. So now come over here, grab your text tool, and say, scalper. And again, you can use whatever number you want. So we'd say we got 50 shares, and we got short at boom. We got short at 219.60. We took profit at 197. So basically $22. Made 22 bucks on half of our position. We're off on half, and so now we're going to let the balance run. And we're likely going to look to take profit down here. Okay, ready? Click, 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 click. There's our next target. Okay, so let's pull. Now this is a support level. This is where we're anticipating the market will hold up. Okay, So on the second half of the position, come over here, on the trader, we had 50 shares, and we made 39. Okay, so this is just under 2 grand. 50 shares at 40 bucks per share is 2 grand. This is around 1100. So this is another $2,100. Now our initial risk was a little bit higher. Let's see, from 219.60 up to 235. So basically we risked $16 per share. So our initial risk was 1,500 bucks. So 1,500. And then our return was, what was it, 1,100 right there and 2,000 right there. So let's call it 3,100. So this trade was a 2R trade. And again, if we took all of it off right here on our first target, we'd still be happy. But every time this happens and then the market goes lower, unless you're crazy, crazy disciplined, you're going to hear your negative internal dialogue. And your brain's going to be telling you, you idiot. And then literally, again, to avoid pain of getting out and watching the market continue to fall, the next time you won't exit here. And it'll go down, and then it'll zip back up. And when price is up here, you'll say, damn it, I should have got out. I could have taken my target here, and then you just start to oscillate back and forth, trying to move away from pain. Or you just say, look, my target 1 is always 1.5R. My target 2 is always 4R. My target 1 is always 1.5. I exit the second half at the blue line. So now what I do is I'll look at this. I'll say, okay, if I used a 4R target, there I'd be out. But again, if I'm out right here, I'm completely flat. But see my oscillator? It goes buried here, and then the next two meet right here. And right there's a higher close. So we could call this a buy signal. So let's buy the next bar at market. Now we'll grab our buy position. Okay, so we buy the open. We have to put our protective stop below the low. And then we go 1.5. Let's move this sell signal over. There we go. And there's our 1.5 target. Okay, so if we go below here, we get stopped out. If we go up here first, 1.5R, and then we wait for the balance. And here we go. Stopped out. Okay, so here we would record this one as 100 contracts, and we got long at 187.16. We got stopped at 172, so let's call it a $15 loss. So here we go. So we go 100 shares minus 15 bucks per share equals minus 1,500. So right now we've done 3 trades, 2 winners, 1 loser, and we're up over $3,000, and so on. Okay, so now when we go through an Excel spreadsheet, we can arrive at statistical data, and we've got a ton of evidence. So here we would look at this and we might wonder, why, what could I have done to stay out of this trade? You know, we got our buy signal down here. We were at a level of support, and then we waited for a higher close and we bought the next bar market. Up here, we had an overbought condition, boom. We were at a resistance level, boom. We got a lower close right here, and we sold the next bar. Okay. Also, had we done that over here, we would have gotten a 1.5R target here, and then stopped out here for better than break even. So actually, we'd be 3 winners and 1 loser right now. And then you just continue to test. And then as you're doing this, you're going to recognize tendencies. So for example, I worked with Paul again this morning, and one of the tendencies we noted on crude oil, we were using a 15 tick stop, and on 3 losers, had we had a 20 tick stop, we would have been able to stay in each of those trades. And rather than lose 15 ticks, we would have hit our 15 tick target, but we needed that additional 5 ticks and stop. Does that make sense to you? Okay. So we wrote that down as one of the tendencies. And that was only on 10 trades, but that's something that I want to consider. So now what I would do is on the next 10 trades, excuse me, I widen my stop to 20 ticks. So here, instead of a $10 stop, we might widen it to 15. And I see what impact that has on the trading. And then I go through, and here's what I encourage you to do. A minimum of 15 to 30 signals. And remember, the key thing here, guys, is syntax. Okay? The syntax is the order in which events occur. Okay? Syntax typically is used in language structure, but it's also the way our brain processes information. And so anytime we build any type of systems, again, remember I talked about the stop sign. Okay? So you don't slam your brakes on and then look for a stop sign, right? Well, Oliver might, but you look for a red octagon, you see that with 4 white letters, all right, you went there, and then your brain processes the information. I know that that's a stop sign, I know what it means, and I know what I do. Okay? So the syntax here, the order of the events is 1, I want my double stoke at an extreme. 2, I'd like this to occur at a key, and I'm going to use the verbiage SR, support or resistance level, or we can look at it at the black line, but right now I'd say just look at SR levels. Okay? 3, enter trade. Well, actually 3, we need to wait for a higher close if long, if we're buyers, a lower close if we're sellers or short. To the prior candle. Okay, so let's look at this. And then as we kind of advance a little bit, I'll teach you 2 really powerful reversal signals. Okay, so just a classic higher close would be this candle right here. Okay, this is where our bar, so look, our oscillators are all buried right here, right? But that's a lower close, it's a red candle. Our oscillators are buried here. We're at our 382 Fibonacci retracement level, and then this is a higher close. So that higher close to us, okay, higher close represents proof of buyers. Okay? Proof of buyers. That's what that represents. So here's what I'd like you to think about this. This bar of data is a visual representation of all the psychology of all the participants in this market for that particular day. Or if we're on a 1 minute, for that particular minute. Okay? So right here, there was more selling volume than buying volume. More sellers than buyers. More sellers than buyers. More sellers than buyers. And then finally, for whatever reason, we don't care why, the buyers came in, and right here the buyers overwhelmed the sellers. And for the first time in 1, 2, 3, 4, 5 days, the buyers were able to win that day, and we see that as a white candle where the close was above the open. Also, our oscillators were buried and we were at a key support level. So I want you to think about this as just combining technical indicators. You got me? Oh, okay. How about now? I don't know what just happened to my charts. That's interesting. Okay. Yeah, exactly. I told you they're listening. Okay, let's get rid of that. All right. So visual representation of all of the participants in the market for that day. Now what I'm going to do is we're going to exit. How do I exit the replay? How about now? Okay, let's go. Okay, we'll go stop streaming. I'll go to screens, share the entire screen, boom, and boom, go live. How about now? Oh, do you? Little treatski? Oh, that's awesome. How old? Oh, that's awesome. Yeah. My little nephew, I guess, just had we went to his second birthday. He is ridiculous. Yeah, man, it's so cool watching him grow up. Okay, let's try this. Let me go to Intel. Okay. All right, so here, let's do this. So here's what I'll do real quickly, and then we'll kind of shut this one down. You can go kick it with your nephew. So the first thing I want to do is I'm going to go to a weekly time frame, and what I want to do here is I want to identify two things. I want to immediately identify, is there a trend present? So is there a trend present here, guys? True or false? Bear trend. Beautiful. So the weekly's in a bear trend. Do you see what preceded the bear trend? Watch. See this? Look. See that level of support right there? Okay. See this level of resistance right there? Okay. So here's what we do. As we pull back to the level right here and then retest it right here and then retest it a third time there, this is where that gains a support relevance for us. Okay, so we would have known this all the way back here. There we go. Okay, so as soon as this market pulled back, I would have posted or done a video or what, and I said, all right, gang, I love this level right here in Intel. Okay, so if we pull back down to this level, blue's above black, we're buy mode. Market's moving, it made a higher high, higher low, equal high, higher low, higher high, higher low holds. So we want to buy every test of this support level with a reasonable expectation they're going to come back up here and test $50. So this is a beautiful risk profile. I can buy it here. I can risk $3 to make $7. And if it continues after this pop, we've got room to run up here. Okay, so what happens? Long entry? Nope, 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 nope. Oh, there's a retest of the high, and there's off to new structure highs. Well, here, let's just do this. How do I get out of replay? That's a question that needs to be answered. There we go. Yes, I want to exit. Okay. All right, so on the weekly bar, I found this support level. Look at this. Boom, we come back down to it. October of 2018. Test, winner for $7. We tested again in December. Boom, another $7. And then we popped back up and we hit that level right there for $15 from 42 to 57. We fall off of a ledge 1, 2, 3 weeks. We're right back down. Guess what? Buy them. Boom, again, winner. Now we make a new high all the way back down. Look at this. Buy them. Once, twice, 3 times a lady, 4, 5, 6, 7 consecutive tests. All of them were winners. Now that's, again, uncommon. Most of the time we won't take action after the third test because this is less likely. But that's a perfect example on a weekly chart of identifying support level. I want to be a buyer here, profit. Buyer here, profit. Buy a call spread, profit. Buy a call spread, profit. Buy a call spread, profit. And then finally, for whatever reason, the sellers take over. And this is a concise and clear break of that support level. Now this will be an expected resistance level if we come back to it in the future. Okay? So what do we have? We have a bear market, but it was preceded by a complete sideways trade. But I've got no action to take here unless I'm a trend trader. Okay? Let's go to WB. Okay, so let's go back to the daily. This is the one I was training with you on, Ollie. Okay, so let's look at turning points. Did we get our oscillator signal here, guys? Okay, come over here, here, drop that vertical in. Okay, did we get a lower close after that right there? Okay, come over here, grab your short position, sell the open of the next bar, the stop goes above the swing high, and then I want to see 1.5R. Did we hit our 1.5R target? Did we hit a 4R target? Okay, so we'd record that as a 1.5 and a 4R target. And now our previous level of support, it became resistance here. We broke below it, came back up to it, sold off. Now we're looking for our next oscillator trade. We don't have any support levels until this guy puts in this little reversal bottom right there. So we're kind of in no man's land right now. Let's see. Here's an overbought right there. Okay. So right here we're overbought back into resistance. See this right there? See that lower close? So this would have been a sell. And we would have been stopped out. Now, this is a stock that's trading at $38. So if we traded 100 shares, we had about a $2 stop. So we would have gotten stopped out for a $2 loser right here. But right now, just a quick look, we got nothing going on. Okay, so we look at the chart, we got nothing. So next, TRV. Bull, bear, or sideways? Perfect. Okay, so here's what I always say. I want you to look left. Resistance here. Swing resistance here. See how that oscillator went overbought? And now price goes boom. New high, higher low. Higher high. We've got a previous level of resistance. Broken. See how it acted as support right there? We would have gotten long at 175 or 178.50. Expected a retest of those highs. 185, that's an $8 wiener. And then right there we go to 190 for a $15 bill. And then we would have been stopped on our trails right there. So right now we have an alert set. So you can come right here, right click, and you can say add an alert. And you can get an alert at 179. And you can say buy calls or look for long entries on TRV. It'll alert your phone, send you an email, whatever. Okay, so there's one now that we do have an interest in. Okay, so if we got short right here, then I would do a 1.5R for target 1. So here, let's do this real quickly. Okay, so let's just say, again, we'll name them. Okay, well, let's just do this. Let's go target 1 is 1.5R. Target 2 is, let's call it static, 4R. Okay? Or trail on blue line. Okay? So if we got long right here, okay, we had a doji higher close with our reversal. We were at a previous level of support. See this over here, guys? Okay, so we go ahead and let's buy our long in. Right there was our higher close. There's our stop. Boom. We hit 1.5R right there. We risked 153 to 146. So we risked 7 to make about 10.5. Then our second target is going to be 4R. There we go. Okay, there's our 4R. Now, if we instead, well, actually, there, right there. So, or we would have gotten out on the trail stop right there. This is the first time we had a close below the blue line. But those are two different ways to exit that second half. Well, if we do a 4R, we're going to miss a couple of trades that go 5R, 6R, 7R, 8R, 10R. Okay? But 4R is a pretty significant move. Yeah. Yeah, let's go look. The NASDAQ's trading right now, so let's go here. No, it's a few. Well, this is the CFD, so this is a different product. But see this guy right here? So this is the NASDAQ 100. We're trading real time. Bless you. Okay, so here's what I do. I go to a 5-minute chart, and I start to identify my key levels. So my, yeah. Okay, gotcha. So, okay, so let's do this. We'll go to trading panel. I'm going to log into the paper trading. Okay. Okay, so we're at 337, 344 tonight. We just missed a buy signal. So, see this right here? Price came down. No, no, it's a private one. It's I'll have to send it to you. I think I can send it to you, make it available to you. What I need is both of your TradingView usernames. So just send, and it has to be perfect. I mean, it has to be yeah, the capitals, the underlines, all that stuff has to be perfect. And then what I'll do is I'll give you permission. So you can just email those to me or pop them in the server. Yeah. Yeah, there you go. That's a good idea where nobody else can see. There you go. Okay, so this right here, guys, would have been, so again, this is really slow trading, but this would have been our extreme oversold condition right here. See it? We bury all the way down to 8. Okay, and then see this little double bottom right here, where a support level where it popped up. Okay, this is aggressive, but then we get the higher close right here. So we would have bottom at 248s, and then right here 256. Again, not a lot of movement, but let's go ahead and we'll test. We'll sell them right here. So here's a trade. Okay, so we're going to sell. I've got mine set to give me a ticket. We'll sell 50. I'm going to, yeah. Yeah, we got to change the settings. So right click in the chart, come to settings, and right here you have to take off instant order placement. Uncheck that. There you go. And then your P&L, you want that to be in money. And then see the orders in the brackets, you want those to be both checked. Down here under appearance. Okay, so now we'll click OK. Now, my stops and targets are a long ways away. So my current position is what? Perfect. Okay, short A, it's red, and B, there's a minus sign next to it. Okay. Now, when I hover over that, do you see the vertical lines coming off of that? That's connected to my stop, which is above the market, and my profit target, which is below the market. Correct. So as I pull this down, now I can see. Okay. Now, I don't know what color that is, but you can see that if price comes up and hits 11,287.1, I'm going to lose 1565. I'll get stopped out. And as I hover over it, I can see that it's also connected to this profit target down here. If price comes down to 11,219, I'll hit target. I'll make 373 ticks or 1865. Now, I don't want to risk nearly that much. So I want to identify a reasonable way to look at where my stops and targets should be based on market structure. Okay, so I want my stops, above this right here. So I'm going to come down. I'll go to 71.20. Now I'm only risking 770. See this area of support right here, guys? Market came down, stopped on a dime, and then from there popped back up. So I'm going to use that support level. Again, I'll drop it in to give you a better visual. I'm going to use that support level right there as my profit target. So I'm going to pull this down. See how I've got my left mouse depressed, and I can move it, and then I left click, drop it in. Still have to click modify, and now I'm risking 770 to make 2200. Okay. Now, if let's say the market starts to roll over. Okay, so here's what I do. I come and use my ruler, and I go from my entry up to my stop. I'm risking 16 points. So from my entry down to my target, there's my 16 points. I'm going to right click right there, and I'm going to say trade. I'm going to buy half of my position right there. That would be a 1R. If I was going to go 1.5R, then I'd go another 8 points, and I'd cover it right there at 1230. So the way I've got it right now is I'm going to go, I'm short, and that's the entry. I've got a corresponding stop. I've got a corresponding 1.5R target. And then I've got this target right here, guys, is based purely on market structure. And it would be about a 2.5R target, likely. 2.5R target. But it's based on market structure. Now, if we just went to a 4R target, then we would go here, grab the ruler, the ruler. Okay, so 15 times 4 is 60. Okay, so my target would be down here. So I'll go ahead and move this down. There's my 4R target. But the thing I'm not real happy about here is this market traded at that level for 10 minutes, actually for an hour, and they couldn't get it to go lower, lower, lower. They kept buying it up, buying it up, buying it up, buying it up. So this is the market telling me this level's relevant. I don't know why. I don't care. Okay. So if I'm at my classic 1.5R, there it is, and then this is the classic 4R. And then obviously if the market starts to move that way, then I'm going to trail my stops accordingly so I can protect my open position profit as the market moves closer to my targets, if it does. And then if I wanted to exit the trade, I'm just like Ollie the other day, you exited that trade. I just come here, click on the X, boom, close it. Yep, all of my orders are filled except the buy limit was not an associated order, so I have to manually cancel that one. Okay. Oh, well done. I removed all my indicators. Genius. Remove the drawings is what I wanted. Oopsie. That's when you know you got a nephew. Oopsie. You start saying oopsie all the time. So what I would encourage you guys to do, let's go back here. I would say get on higher time frames, but go back in, and even if you do it on the 1 minute NASDAQ and go look at last Monday, Tuesday, Wednesday, Thursday. Remember, last week was an off week. We had a 2-day Fed meeting and then the Fed announcement on Thursday. So it's going to be a little slower than some volatility and what have you. But the key thing to focus on, if you want to, just to really look for extremes, move your higher level up to 89 and your lower one down to 11. It's going to issue fewer signals for you. And then literally just go in here and just grab your vertical line over here and just wait until all of these are plastered. Boom. And then just start to watch, just like we did earlier. Boom. All of them are plastered. This guy went extreme overbought here, and then these two followed it. So this would be an area right there. And then it'll help you identify key turning points, key reversal levels in the market, and help you start to identify entry signals. Absolutely. So these are all CFDs, guys. So type in US30 USD, US30 USD. It's a CFD. So as you type in US30, it'll come up, and just set your deal to indices. Okay. See, it says index or CFD. You want CFDs. These are corresponding to the futures markets. Okay, the next one you want to do is SPX 500. SPX 500 USD. Yeah, I just do it. It's easy. I like a bigger area so I can see more data. So I go here, and this would be like maybe a 60-minute chart or a 30-minute chart, and then I can quickly come right here, boom, and then this would be my 1 minute, and I would trade from this one as an example. But yeah, you can definitely. I used to have it where I had four, different things. It just became a little small. Okay. So you want the SPX 500, you want the US 30. This is the 30-year bond. I'm sorry, this is the Dow 30. You want the US 2000, which is the Russell 2000 index. 2000 USD. I'm putting them in the deal too. Okay. There we go. Okay, there we go. Yeah. Why not you? Why not you? Whoopty picture. Okay. I don't see a little area that'll drop these in. Camera unavailable. Start an activity. Stop streaming. Mute. Oh, it says welcome to morning meetings on the right side. Okay, now here we go. Okay, so it literally took over the whole thing now. Gotcha. Okay, so SPX 500, US 30, USD, NAS 100 USD, and then US 2000 USD. 24 hours a day, 5.5 days a week. Typically, they come back on 5 p.m. Sunday, and now we'll go all the way through until 5 p.m. Friday. And so this would be the same as the Russell 2000 index. This is the S&P 500 index. This is the Dow 30 index, and this is the NASDAQ 100 index. So you'll see, I mean, they're highly correlated. They're all U.S. equity indices. So as an example, you'll see right here, the Dow is right at a beautiful resistance zone. So here, well, again, I blew up my indicators, but right here, I would look for this to be a sell signal. So if we got a lower close right here, we've got this resistance level. Promise you the oscillator is overbought. And so here, let's just sell them. So I'm going to go sell market. US 30, we use different size here. We'll go take profit, and then we'll take this down to 400, and then we'll do, actually we'll do this, we'll do 200, and then we'll do an 800 point target. So that's a 1-to-4 ratio right there. There we go. Yeah. So that would lock in my 4R ratio. And then if I wanted a 2 or a 1.5R, again, what I do, just because it's quick, grab the ruler, boom, that's 20 points, so I go to 30. That's 20 plus 50% of 20 is 10. Then I pull it down to here, I right click once, it gets rid of the indicator, right click again, and then go boom, buy 15. So now I'm going to sell another 30. Okay, now I'm short 30. My protective stop is here. I'll lose 615 if I get stopped out. I've got a 1.5R target on half of the position. 30 divided by 2 is 15. I want to buy 15 here. If price comes down and hits my profit target on 15, it'll automatically adjust. This will become 15. It'll cancel my 30 and replace that with a 15. And this will cancel and replace this with a 15 as well. If we go up and I get stopped out, this order has to manually cancel. So I'd have to come in here and manually X out of this, just like I did on that NASDAQ. Okay, so we're short right now on the Dow 30. Okay. Yeah, paper trade, but again, that's the key. That's the key. So the key thing is, so just remember this: everything you do well, you've done over and over and over and over. Again, repetition, 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 critical. So you have to promise yourself right now that you're not going to come over here and just jack around. You know, let's go buy Bitcoin. I heard Shiba Inu's going crazy. No, none of that BS. Okay, you have to be disciplined. Repetition's the mother of skill, right? Everything you do well, you've done over and over and over. But remember, if you start to develop bad habits here, you're going to make the exact same errors when you start trading real money. So you got to. So for example, for me, I call this an SOS 4 sell. I have 4 different technical reasons to be short right here. My double stoke was overbought. That's 1. I'm at a resistance level. That's 2. I have indecision. This is called a doji candle, where it goes up, goes down, but then closes right in the middle. Here, let me show you. See this? This is called a doji. This is an inside bar. The high is below the prior high. The low is above the prior low. A period of indecision, another period of indecision, and then right there is my lower close. That was the reason for the short entry. Okay, so I have 4 different technical studies that are all showing confluence. Now, look at this big honker. We're up 315. So now I'm going to start to trail my stop. I want to reduce my risk. Okay, we've got a big round number. This is Dow Jones 32,900. So markets tend to react around big round numbers. 33,000. 32,900, 32,800, and so on. Okay? All right, dudes.